one of the things that when I did some research before looking at the ethical funds that had done quite well, and one of the two trends really that came to the fore, there was a definite bias towards smaller companies, and there was a definite bias towards technology in there as well. So two trends that have done really well compared to their sort of counterparts in the sort of recent history. So does that, is there an element where if you invest ethically, you need to look under the bonnet for these things? Because you could actually be taking a style bias that is potentially boosting your returns, but actually therefore skewing your portfolio in a certain way. You need to counter that.
Yeah, I mean, we look at three. We decided to try and get our own criteria for ethical investing. We came up with 3 different styles, which we think most funds would broadly fit into. So one is what we've already talked about already, which is screening out the bad stuff. So we call that avoids. And then there's the style where it's mainly active fund managers are going in and looking at under the bonnet of the companies that they're investing in and seeing what their ESG practices are and taking that very seriously. So we call that considers. And then there's a different style where it's thematic, and the whole ethos of the fund is to look at a particular theme or sector and fully embrace what's going on. So we call that embraces. And I think you've got to be think about the balance within the portfolio and what you're putting in there, and whether you've got exposure to different regions of the world and different industries, because I think that's still very important when we're investing our nest eggs for our retirement. It's true, Damien, if you did go into clean tech or clean water or clean energy, you're very potentially in an area which could do fantastically well, or it could do badly, and you might have a limited exposure to a particular sector or even region of the world.
I would add that that's totally true, but also happily, there are areas of environmental investing that do involve less risk. So, I think often when people think about climate change solutions, they're thinking about, clean tech, alternative meat, these sort of new startup companies doing these really interesting, crazy things, but that might be more high risk. So you do have the potential for higher returns, but you're taking more risk. But actually a lot of what is needed in terms of environmental investing is energy efficiency, and things looking at the circular economy, recycling and waste management, and quite boring stuff, like not the kind of stuff that's going to make you feel really excited, like that someone's inventing something new, but really important for all companies in any sector to cut their emissions. So you do also have investors or funds that are targeting companies that are setting, any company, be it Microsoft or something, that are setting good targets on reducing emissions. And a lot of those companies do tend to be large and listed, and so not the kind of companies where you're going to make crazy returns. But that's great, because that's what a lot of investors want, is something a lot safer. So I think good thing about it is depending on your risk profile and how much risk you want to take, you can probably find companies and funds that will suit you depending on what you want to do. You're totally right that you need to check that you're balanced out in terms of all the sectors and types of companies you've got in your portfolio.